Oh, there's so many yummy vegetarian options out there. You could try like lentil soup, veggie burgers, tofu stir fry. The possibilities are endless.
Hey there, and welcome. So, you run a business, right? And I'm willing to bet your family helps out a lot. But here's the big question. Are you actually turning all that help into a serious tax saving strategy? Well, that's exactly what we're going to break down today. We'll get into how to legally hire your family, write off their pay, and unlock some pretty amazing financial perks. All right, let's get right into it. Okay, so let's kick things off with a story that probably hits close to home for a lot of you. Meet Raj. He and his family just opened their dream restaurant. You've got his wife and daughter in the back, killing it in the kitchen, while he and his son are holding down the fort out front. The place is starting to make a little money, which is great, but Raj hasn't paid anyone officially. There's no paperwork, no records, nothing. So now tax time is rolling around, and he's got this big question mark hanging over his head. Can I just, write all that work off after the fact? And well, the short answer is a hard no. But, and this is a big but, the good news is he can get everything set up right now for some massive savings down the road. All right, so how do we get from Raj's messy situation to a really smart, tax-savvy solution? Here's the game plan for today. We'll look at this common dilemma, then tackle the big employee versus contractor question. We'll cover making the hiring official, how to actually run payroll, how to unlock some sweet tax-free perks, and then we'll wrap it all up with a final checklist. Let's do it. Okay, so let's solve this problem for Raj and for you. How do you make sure your business is set up the right way? It really all boils down to one single, super important rule you just can't forget. And here it is. This is the absolute golden rule. You have to treat the whole process of hiring and paying your family exactly as if you were hiring a complete stranger. Every single step, I mean everything. The job offer, the contract, timesheets, the paychecks, it all has to be formal. No more handshake deals, no cash under the table. Your paperwork is your proof. And believe me, without it, you can't write off a single cent. It's that simple. Okay, keeping that golden rule in mind, we've hit our first major fork in the road. This is a huge decision, and it basically defines all your legal and tax duties from here on out. The question is your family member an employee, or are they an independent contractor? So why am I making such a big deal about this? Why is this the most important decision you'll make? Because honestly, the answer changes everything. It tells you whether you're the one who has to deduct taxes, CPP, and EI right from their pay, or if your family member is on their own, responsible for handling their own business taxes. Getting this wrong can lead to some serious, and I mean serious headaches with the Canada Revenue Agency. You really have to pay attention to the wording the CRA uses here, because the entire difference comes down to one tiny word. You've got a contract of service. That means you've got an employee. You're the boss, you call the shots, and you have to make those payroll deductions. Then there's a contract for services. See the difference? That's a business-to-business deal. Your family member is basically a subcontractor. They send you an invoice, you pay it, and that payment is a nice, clean deduction for your business. Okay, so how do you actually know which one it is? It's not like you can just pick the one you like better. The CRA, they don't just take your word for it. They're going to look at the reality of the situation, and they do that by asking these four key questions. It's all about control, right? Who has it? Who's supplying the tools and equipment? Is the worker taking on any financial risk, or is that all on you? And finally, how independent are they really from your business? Let's make this concrete with an example. All right, let's meet Marina and Paul. So Marina does all the bookkeeping for her husband Paul's construction company. She works out of their home office, but she's using a computer that Paul bought specifically for the business. He's also asked her to be on call, basically, between 9 a.m. and 2 p.m. every day. And here's the kicker. Paul is her only client. So, what do you think? Employee or contractor? This is a perfect example because it shows you the two different paths so clearly. Based on everything we just heard, Marina is almost definitely an employee. Think about it. Paul controls her hours, he provides the main tool, the computer, and she's totally integrated into his business. He's her only client. So yeah, he needs to put her on the payroll and give her a T4 slip at the end of the year. But what if we change the facts a bit? What if Marina used her own laptop, had a bunch of other clients, and just sent Paul an invoice every month? See? In that case, she'd be a self-employed contractor, and she'd be the one responsible for her own taxes and CPP contribution. All right, great. So you've made the big decision, employee or contractor. Now for the really important part, making it all official. And what was that golden rule we talked about? That's right, paperwork is everything. When the CRA comes knocking and starts looking at your deductions for paying a family member, you can bet they're going to have a checklist. And these are the 5 things on it. 1. Was the work actually done? 2. Was it necessary for the business? Something you would have had to pay a stranger to do anyway. 3, and this is a big one, was the pay comparable to what you'd pay a stranger? 4, was it reasonable for their age and experience? You can't pay your 16-year-old son $100 an hour to take out the trash. And 5, was the work all done to help the business make a profit? You got to be able to say yes to all 5. Okay, so you've dotted the I's and crossed the T's on the employment agreement. It's formal, it's legit. The next logical step is running payroll. Now, I know that word can sound a little intimidating, but I promise you, it's just a process. It's a clear, step-by-step playbook, and if you follow it, you'll be totally fine. Really, when you strip it all away, payroll is just this one simple equation. You start with the gross pay. That's the total amount earned, which could be cash plus any taxable benefits. Then you subtract all the deductions. We're talking CPP, EI, income tax. And what's left over? That's the net pay. That's the actual dollar amount that lands in your employee's bank account. So let's walk through the actual cycle. It's about 10 steps, and we'll take the first 5 right now. Step 1, you have to open a payroll account with the CRA. That's how you get your RP number. Step 2, your family member fills out a TD1 form that tells you what tax credits they have so you know how much tax to withhold. Then you'll determine their CPP and EI premiums. The CRA has online calculators that make this super easy. 4, you calculate the net pay. And 5, and don't forget this part, you also have to calculate your share, the employer's portion of CPP and EI. All right, the last 5 steps are all about putting it into action. Step 6, you add up everything, the employee's deductions plus your contributions to get the total you owe the CRA. 7, you send that money to the CRA, which is called remitting. It's usually done monthly. 8, and this is critical, you record everything perfectly in your bookkeeping software. 9, you prepare the actual pay for your employee. And 10, you get your records all set up for the next pay period. Rinse and repeat. Okay, you've got the fundamentals down. You're basically a payroll pro now. So let's level up. Let's talk about some of the more advanced strategies that can make paying your family even smarter and more tax efficient. Because trust me, it's not just about the salary. And here's why this is such a big deal. $1 you pay someone in salary is not the same as $1 you pay them through a tax-free benefit. It's just not. By using these perks strategically, you can get a business deduction, but your family member gets to keep more of that money in their pocket because it's not taxed. It is such a powerful way to boost their total compensation without just throwing more salary at them. And the cool thing is, there are a ton of options here. Paying the premiums for a private health and dental plan, that's a huge one. It's a 100% deduction for the business, but it's not a taxable benefit for your employee. It's a total win-win. You could also pay for job-related training to help them level up their skills. You could subsidize their meals, or maybe even cover a club membership if it's mainly for business purposes. These are real, valuable perks that don't add a penny to their personal tax bill. Okay, now this is a pro tip. This is a fantastic tool that helps your family keep more of their own money all year long instead of waiting for a big refund from the government. If they have big, predictable expenses, like they make regular RRSP contributions or have significant childcare costs, they can fill out this form, the T1213. If the CRA approves it, they'll send you a letter that basically gives you permission to reduce the amount of income tax you withhold from their pay. It's like getting their tax refund back in every single paycheck. It's amazing for cash flow. Woo, okay, we have covered a ton of ground here, right? From the absolute must-follow rules all the way to some pretty cool advanced strategies. So before we wrap up, let's boil it all down into one final, simple checklist. This is to make sure you've got all the key takeaways locked in. All right, here are the absolute must-dos. Number 1, formalize everything. I'm talking contracts, job descriptions, the whole 9 yards. 2, know the difference between an employee and a contractor like the back of your hand. 3, know your deadlines. When you have to remit to the CRA when T4s are due, don't miss them. 4, understand exactly when you need to deduct CPP and EI. And finally, number 5, use those awesome tax-free perks to your advantage to build a smarter, better compensation package. So here's the bottom line. Let's be real. Setting all this up the right way, it takes some work. It requires you to be diligent to keep good records. But the payoff? The potential tax savings from income splitting and taking legitimate business deductions, it can be an absolute game changer for a family business. You now have the tools, you have the framework to understand how this all works. So the final question, the one you need to discuss with your tax advisor, is this. Is putting in that effort worth it for your family and for your business?